Hey everyone, this is Holly Kaufman. I am a real estate agent in Houston, Texas, and I have with me today one of my mortgage lenders, Stephanie Drewry from C&T Mortgage. She has volunteered her time to go through a closing disclosure with us because I usually get a lot of questions, and I like to say, "Hey, ask your lender," but I think it's great education for everyone to be able to kind of walk through slowly. So she's going to stop and explain little sections that she normally gets questions on regarding a closing disclosure. So Stephanie, I'll let you take it away.
Awesome. Thank you. Yeah, like Holly said, I am Stephanie. I'm with C&T Mortgage, and I have been with them for quite a few years now. So like Holly said, kind of want to break down the closing disclosure a little bit. What most people don't know is the only items a lender controls on the closing disclosure is the interest rate and the lender fees. Everything else is generated by the title company, except homeowners insurance, which the consumer, you guys choose on your own. So with that being said, when I get questions that I don't know the answer to, I usually have to get with the title company because there's some calculations that they end up doing that we don't have access to. So with that being said, I'm just going to kind of jump into this one. This is one from last month with a client of mine. And so at the top is just going to have your basic details. It's going to have the date, the close date, disbursement date, which is another word for funding. And then, the title company, the address, the borrowers, the sellers, and of course the sales price, which you'll see there at $410,000. And then loan information. So this is a 30-year conventional loan, pretty basic product. So we'll just kind of get into it. So sales price right there, $410,000. I don't really get many questions on this first part. They usually know what they're financing. So they're financing the loan amount right there is $369,000. And when we locked in, based on what the market was doing, the day we locked was 6.375. And they're actually paying a little bit for that rate to buy it down a little bit. And we'll get in that in just a second.
Perfect.
Now, right beneath that, monthly principal and interest. So this is just the principal and interest payment by itself, not including any homeowners insurance, property taxes. Again, I don't really get many questions there. So we'll just kind of keep going down.
Okay.
Projected payments. This is kind of what I want to stop on. Okay. And here's why. So again, you'll see the principal and interest there at a little north of $2,300. You've got your estimated escrow, and that's your taxes and insurance at $679.
So what's escrow?
Escrow, great question. So escrow is the best way to describe an escrow account is a savings account for your mortgage.
Okay.
So if you put less than 20% down, we do have investors that we can waive escrows at 10% down or even 5% down. But for the sake of simple guidelines, let's say that less than 20% down, you have to have an escrow set up. So basically every month that you're making that full monthly payment, your principal, interest, homeowners insurance, and property taxes, your homeowners insurance and property taxes are set aside on your behalf. That way, when your taxes and insurance come due, the lender pays it directly out of your escrow account, and the consumer really doesn't have to think about it that much.
So if I have over 20% down, I could essentially be my own escrow and save money monthly for my taxes or pay my insurance yearly. I wouldn't need an escrow if I have more than 20% down. Is that correct?
Correct. If you chose not to, and you can also do partial escrow. So I'll get some people that are like, well, I want to escrow my insurance, but I don't want to escrow my taxes. I'd rather just handle that myself. So definitely an option as well.
Awesome.
So in this particular scenario, the buyer put less than 20% down, which triggers monthly mortgage insurance. Now, a caveat of that is there are ways to get around mortgage insurance if you put less than 20% down. But Holly and I are going to get into that in a totally different video, so we can go more on that. Sure. So right here, you're seeing years 1 through 9 that they have monthly mortgage insurance of $64.58. And then next to that, you see that it falls off year 10. With that being said, that's just a calculation that the lender, so to speak, is utilizing as to when you will reach 20% equity into the property, technically 22%. So what I mean by that is when your home reaches 78% loan to value, which is what this calculation is basing it off of, is when the mortgage insurance will fall off by itself. Now, if you feel that you have reached 20% equity in the property and you've carried your mortgage insurance for 2 years, then you can reach out to the servicer and request to have that removed. So I will use my own personal story on this. So when we bought our home back in 2020, we put less than 20% down and monthly mortgage insurance. Last couple of years, the market has shifted upwards tremendously, where we felt that we had enough equity in the property to remove our mortgage insurance after we had held it for 2 years. So what we did is we reached out to our servicer and answered a bunch of questions, and they sent out their own appraiser to our house and assess the value, not a full out appraisal or anything like that, but assess the value and any improvements we had done to the property. And so when all that came back and everything looked good, we were actually able to remove our mortgage insurance. So a lot of people don't realize that you can request to have that done. In today's market, I have my buyers on a 2-year clock, and I'm reaching out to them to say, hey, let's check the value of your home and see if we can save you, a few bucks here and there, because we know people aren't refinancing right now.
Absolutely. Did that cost you anything for them to do that?
The only thing that there was a cost was for the appraiser, their appraiser to come out. And honestly, it was just a couple $100. So if you're paying $64 a month, it's just going to take you a few months to recoup that.
That pays for itself pretty quickly. Yep. That's awesome.
Exactly.
Awesome.
Underneath that, you'll see estimated taxes, insurance, and assessments. Assessments refers to homeowners insurance. So like Holly had brought up, if you didn't want an escrow account set up, you would notice that the amount over to the right side of the column where it says in escrow, it no for taxes and insurance. It's always going to say no for homeowners insurance because you don't escrow homeowners insurance.
Perfect.
So
when you homeowners association dues, is that correct?
Yes, exactly. Okay. Yep, exactly.
So what does that mean? So I've owned a home, I'm buying my home now. Whenever you see this box checked and this says no, that means I have to figure out another way to pay for my homeowners association dues, like through their website or something like that. Is that correct?
Exactly.
Okay.
And yep, exactly. And so one thing that's confusing is it's not broken down on here, but when you look at somebody's loan estimate or estimated fees worksheet, you'll notice that homeowners insurance has a monthly payment in your payment box, so to speak. I always have to emphasize you don't pay it monthly, you pay it annually, unless of course it's like a condo or something like that.
Sure.
That causes confusion. But yes, you, the homeowner, are responsible for your home association dues, and believe me, they will remind you.
Absolutely.
Get those paid.
Perfect.
Underneath this, I don't see a lot of questions, but where I do, for costs at closing cost, where you see $14,623.98.
Yep.
That's the first thing buyers like to look at. Yep. And I get, before they even scroll down and look at the rest of the closing disclosure, I'm getting calls saying, you're not factoring in my credits. You're not factoring in the earnest money or anything that's already come off of it. So we'll get into that
a little bit later.
On the pages. Cash to close, I get a lot of confusion on this too, because people think that sometimes this is just not including their down payment. This funds to close, that cash to close right there, and that box is including all down payment, all closing costs, minus any credits or any money that you've already given up front.
So that's the full balance. Yeah.
That is the bottom line. That's what you're borrowing to the title company for closing or getting a cashier's check.
Perfect. Is seller concessions also in there? Included?
Yes.
Okay.
Yes.
Perfect.
It's just not included in that top number.
Perfect. Want me to continue scrolling?
Yep. And so we will stop here on section A just real quick.
Okay.
Section A are your lender fees.
Yep.
And what I had hit on at the beginning of this video was there was a slight buy down for this interest rate that the buyers chose to do. So
what's a buy down?
You're seeing that as loan amount, or the percentage of the loan amount and discount points.
Okay.
Sometimes the verbiage discount points on there. A lot of consumers think that it's a credit, which I didn't do this for a living. And you said discount, I'm looking for that discount. So it can be a little bit confusing. But other than that, section A is the lender fees. That's the section that we control.
Okay.
Everything for this has pretty much nothing to do with us, but I definitely want to go through it. So Section B. We'll go to
Do
section
you mind
B.
if we stop right here and talk about a buy down and what that is?
Yep, absolutely. So I don't recall what the par interest rate was for this day. And what I mean by par interest rate, it just means the basic interest rate where there's no cost associated to it, nor is there any margin back behind that pricing to offer a lender credit.
Okay.
Sometimes I get people and they just want, what's the lowest rate? Are you looking for the lowest rate with the highest cost? It's really digging deep to see what they're wanting. Right now, it doesn't matter who you talk to, people want the lowest rate. I want the lowest rate, you want the lowest rate. So it's my job to let them know that they do have options. So
Absolutely.
what I into and what I really break down is after I've, built that rapport and talked to the consumer is you said that you wanted the lowest interest rate. So here's the lowest interest rate I'm seeing on the rate sheet today, and it's going to cost you this much. You already told me that you're going to be in the home for 5 years, probably max, and it's going to take you 8 years to recoup the cost of buying down in that scenario. So these are just discussions that need to be had because at the end of the day, the consumer, typically they don't know. They just see the lowest rate and that's what they want, but we need to discuss, what the cost associated to that is.
Okay.
Does that help?
That helps a lot.
Okay. Section B, appraisal, section B, 1. Okay. So another question I get probably 95% of the time is, we've already paid our appraisal fee. Why is it still showing on here? So if you scroll over and look at the section that it's in a section called paid before closing. So we know that you've already paid for it. We still have to disclose it to you regardless of what you've paid. You're just seeing it in the section showing that we know that you have paid this before closing.
Perfect.
Doc prep fee, that's really just our attorney fees. And you'll actually see a $350 lender credit at the bottom for it just because, and I don't know how this could just be for C&T Mortgage, or I don't know how other lenders might have this in their closing disclosure. Mm-hmm. We typically don't know what attorney we might be using to draw up our documents. So we don't really disclose it up front, which is why we give a credit for it. So the consumer's never paying for it.
That's fantastic.
Mm-hmm.
Want me to move down to C?
Yep. So section C, I'm working from home today, guys. That was my dog, Hallie. And closing disclosures. Section C, the only thing I want to notate in here, and you're not going to see it on the section L that we'll cover, but just for the sake of conversation, I want to have this, I just want to bring it up. So services borrower did not shop for. These are all the title company fees. We give you an estimate at the very beginning based on what we see on a daily basis. It's never going to be exact because we're not the title company and we don't have their fees right away. With that being said, section C, line 5, lender's title insurance, typically referred to as OTP, just different lingo for it. Usually the sellers will, depending on your realtor and their negotiation tactics, especially in this market right now, usually the buyer might get credit for this. Yep. In this case, they're not going to, but you'll see that it's the heftiest fee in that section, which is why a lot of times, the buyers want the credit for it. So when we get to the section, I'll show you where you typically see that credit. I just wanted to bring it up because it's a question that I get all the time of where's my credit for the title policy and why is it not matching? Why is my credit not matching what the actual policy is? And the reason for that is there's still a $100 fee the buyer pays for this documentation, so to speak. Mm-hmm. So in this case, they would only get a credit of $21.50, not the full $22.50.
Got it. And this is in the section where whenever you're looking at the 1 to 4 family document, this is title will be paid by seller or by buyer. And in this case, it's paid by the buyer. Is that correct?
This is paid by the buyer. Yep.
Okay.
Exactly.
Perfect.
Underneath that, really nothing much to cover. It's just really summing up what those costs are. And then we'll get into other costs. So scroll down a little bit. So real quick, just want to talk about prepaids and initial payment for escrow. So prepaids is anything that needs to be prepaid. And so you'll see the 12 months of insurance in there. Mm-hmm. The home has to be insured. So you're paying 12 months up front to pay for this year. A lot of home buyers don't realize that. And then prepaid interest, it's just the days of interest that you are paying from the day we close until the next month, because it's due in arrears. Initial escrow payment at closing. So this kind of goes back to what we were talking to when you had asked about an escrow account. And here's where I get a lot of questions. So when I disclose, a loan estimate, you only need 3 months of insurance, which is in here, but I also only showed 3 months of taxes. And here you're seeing 8 months of taxes. And the reason being is from now till December, or not now, but from when this close date was, from that close date to December, there was 8 months of taxes that still need to be paid. So you're going to get credit for January 1 until your close date by the seller for the property taxes, because you don't need to pay for the amount of days that you haven't been in the home. And you'll see that credit here in a different section as well. So just kind of a lot of going back and forth on these. So when I go through these with my clients, we're going back and forth just like we are in this video.
Awesome.
And then aggregate adjustment, I'm not even going to touch on this because nobody knows what the true calculation is for this. We don't know how title comes up with this aggregate adjustment.
So we're going to pause. And I understand after doing a quick Google search on the aggregate adjustment why Stephanie says, I don't know how they come up with this number. But I did some research and I want to walk through an example for you that I found. So first off, let's talk about the escrow account. First, the account is set up to pay up your taxes and insurance, and then your PMI if applicable. PMI comes into place if you have less than 20% down, remember? So each month, you pay 1/12, you have 12 months a year, of your taxes and insurance costs into escrow as part of your monthly mortgage payment. These funds are held in your escrow account until your taxes and or your insurance is due. And at that time, the funds are used to pay for these costs on your behalf. So say your insurance is due in February, they're going to collect it throughout the year and pay it for you in February. And in this example, your property taxes are due in November. So they collect it and they make sure that they have enough to pay for your property taxes in November. So let's walk through this example. So first you have a closing date of your new home of July 15th. You get the keys, great. Your first payment is due on September 1st. The reason they do that is interest is paid in arrears, and in order to accrue the interest, they will usually push you out a month, month and a half, which is really nice whenever you're moving in. You don't have that first payment hit you 15 days later. So the first payment's due September 1st. And then your annual property taxes are due in full on November 1st. This is an example I got off the internet. In Texas, your property taxes are due in January. But for this example, we're going to use November. So, thus, you will make 2 payments, your September 1st payment and your October 1st payment, before your property tax bill is due. Your November payment probably won't process in time. And this results in an advanced collection of 10 months of property taxes and a cushion of 1 to 2 months. So you paid September, you paid October. The other 10 months a year, they have to collect whenever they're doing the closing disclosure to make sure that you have enough in that account whenever November comes around and you have to pay that bill. So from the time frame of January 1 to July 15, your seller, so you're the buyer in this case, your seller will pay January 1st to July 15th, and that will be a credit on your closing disclosure. Which we've already seen, right? But that July 15th and on, that is your responsibility. So either way, this amount goes into that escrow and it is there to pay for these amounts. From that, let's talk about the aggregate adjustment because we need to get there. So the lender's calculation may result in too much money being collected according to the Consumer Federal Protection Bureau. And I'm going to put a link up to the actual law and how it's written here, and so you can kind of look at that yourself. But that's where the aggregate adjustment comes in. Your title company goes, we cannot have anything more than 1/6 of your total annual payments as a cushion. And if that cushion is too big because your payments are really due pretty quickly, then there's going to be that aggregate adjustment. And it may be large, it may be small, but that is the title company making sure that there's not too much cushion in your escrow account. All right, back to Stephanie.
Other, so we'll go down just a little bit to other. This is really just other. So if it's a new construction, you're going to see different builder fees. For here, we're just really seeing, HOA fees. There's one thing I wanted, actually, I guess it's not on this one. It's one of those, we don't really have this until the title company sends it over to us in terms of the HOA fees. Now, the owner's coverage premium, you'll notice that says optional.
Mm-hmm.
This really to protect the buyer. So let's say somebody purchased a home. So just like lender's title insurance protects the lender, the owner's coverage protects the owner.
Yep.
So perfect example is you purchase, let's say, a pre-existing home, a resale, and that seller had hired a contractor at one point to come do some work, and that seller didn't pay that contractor. This protects the buyer from that contractor, or from them coming after you for payment.
Awesome.
So,
and how do you know that you can buy this additional coverage? How do you know that you can buy this additional coverage? Are you the one?
The title company will go over it with you.
Perfect.
We just it as just like a minimum fee. I never know what it's actually going to be, but the title company, I leave this in their hands. I'll bring it up, but you know me, I like to stay in my lane, and I let the title company get into it in way more detail.
Absolutely. So this is something that the title company reached out to the buyer, your buyer that you are representing from the lending side, and said, hey, here's some additional coverages that we can apply to your loan, or to your title policy, not your loan, your title policy, in order for us to cover additional issues that could come up and cloud your title in the future. Is that correct?
Exactly.
Okay.
Exactly.
Perfect. Yep. Perfect.
Section I, that's just adding up all those fees that you're seeing. And then you're seeing the total closing costs plus the other fees as well, for a total of that $14,323. Okay. You're seeing that lender credit.
And that was for the $350 for the.
What was that?
And that was for the $350 for the lawyer fees.
The attorney fee.
Attorney fees.
Yep. Exactly. Perfect. So you'll see that, your buyer, so to speak, is never paying for that on our end with C&T Mortgage.
Perfect. All right.
Right here, it's really just comparing that initial loan estimate that went out to the consumer versus what the final closing disclosure is stating. So really not a huge difference here. And I don't typically get a lot of questions on this section because it's explained going through all the other sections. And that's when they typically understand.
Yeah. So
one question that what was that?
Go ahead.
No, go ahead.
So the deposit is essentially the initial amounts that they pay, whether it be the option fee or the earnest payment, as in that first 3 days of going under contract. Is that correct?
Yep. So right there on the loan estimate. So the way our system is, we combine the earnest money and the option. And so in this case, the earnest money was $4,100, I believe, and the option was $300. So we combine it as a total of $4,400. And then next to that on the final, you'll see that it's broken down with just the earnest money, but you'll see in a different section of where they're getting credit for that $300, and that the final line right there for adjustments and other credits, where it says that 1727.02, that adjustment right there, you'll see where that comes into play as well. Perfect. As to why there's an adjustment on there. And
remind me what seller credits mean.
Seller credit is any credit that the seller that has been negotiated. So if they're offering contributions, say for example, this was based on the inspection. So instead of having repairs done, our buyers felt more comfortable just asking for a $1,700 credit for the repair that needed to be made. So the seller agreed to give a $1,700 credit. And this can be negotiated right when you submit an offer. It can be negotiated throughout the process. And one thing I like to notate, it's never guaranteed.
Yeah. Go ahead.
I was just emphasizing it's never guaranteed.
Yeah. So with seller contributions at closing, there is usually a max amount that can be applied to a loan. Is that correct?
Yep. And it just depends on the loan product. And not to get too technical, because I think that should be a video to really get in depth for, but 9 times out of 10, you're never going to see So what the limit is, so what the max contribution is, and it varies on conventional loans depending on what the LTV, loan to value ratio is, layman's terms on how much you put down.
Yep.
But say, it's 6% in this scenario, and that's your closing costs don't reach that full 6%. They're typically never that high unless you have a lender charging outrageous fees, which you do see sometimes. So usually you never reach that amount. And so it's always good rule. If you're working with a good realtor, they will know to call the lender to say, hey, we're trying to ask for max contribution. What do you think that's going to be? It's impossible for me to know until we have everything in, but I've done this long enough to come up with a good amount of what to expect. Now, if there is any overage, and I see this a lot and I don't know why, but leaving money on the table. We'll get with your lender if there's overage and let's see what the cost to buy down the interest rate is. That way we can technically add more closing costs to reach the amount. So there's different ways to look at it. Just a good realtor like you knows to call the lender and let's discuss these numbers ahead of time.
Perfect. And a good lender like you sends me the number after the inspection report's sent.
I try to.
Awesome.
Section K. Section K is adjustments for the buyer. So right here, and it's different on every closing disclosure. So just know that this is not what you see every single day. It just depends on, it just adheres to the certain transaction that we're in. So for instance, assessments, we're talking about HOA in this case. So remember in the beginning, we talked about the HOA comes due. Some HOAs give you till the end of January. Anyways, you pay your HOA up front. So the seller has paid the HOA up front. However, they're not living in the house for the full year, right? They're selling their home and the buyer's taking over. So you're seeing that the buyer is paying from the close date to the remainder of the year of $446.71. And this community also charges garbage fees, which this is the first time I've seen this. So they're collecting for that as well because those two items were paid ahead of time and it's now a cost for the buyer.
Perfect.
Section L. This is going to kind of tie everything together.
Awesome.
Section L is the buyer's favorite section. It's all the credits and adjustments and everything like that. So right off the bat, you're seeing the deposit on L1 deposit of $4,100. This was the earnest money. So instead of it being combined as, just bundling the option and earnest as one, it's broken down for everybody to see. So they're getting credit right there for their earnest money of $4,100 that they've already given. L5 is another credit. It's that $1,700 credit that was negotiated for the buyer to obtain. And then right there, you're seeing that $300 option fee that they're also getting credit for.
Perfect.
Now, here's where the whole 8 months of taxes comes in. So section L13. So you see how county taxes for January 1, 2023 to May 16th, 2023. The buyer is getting credit from January 1 to their close date of the property taxes simply because they did not live in the home. So yes, while you see 8 months above on the previous page that we went over, yes, it's being collected, but you're getting it right back here on section L. It's just the only way that we're able to disclose it this way on a closing disclosure.
Perfect. That seems pretty self-explanatory.
And then once you go through all the calculations and everything like that, you again see cash to close from the borrower, $47,446 and some change in this scenario.
Perfect.
I never really get questions on, just the verbiage pages of the disclosures or anything like that. It's obviously just information for the consumer. This loan is not assumable. Demand feature is just basically letting them know that there is no prepayment penalty. So if they want to pay their home off, 6 months from closing, they're more than welcome to. There is no prepayment penalty.
Perfect.
It also discloses, any late payment fees or anything like that.
Awesome.
This loan has an escrow account. So it's just giving you information on that. If you look below that box, there's also a box notated if you were to waive escrows. And so basically we would just check will not have an escrow account, and the consumer chose not to have one.
Perfect.
And when it comes to escrow accounts, I always get the question of, well, what would you do, Steph? At the end of the day, it's a huge personal preference. And when I first got in the industry, I was all for escrow accounts. Why would you not want one? And after seeing taxes and insurance and stuff go up and learning through my own personal story, basically, I understand why a lot of people choose to waive escrows. And another reason too is there's a lot of savvy people out there that, each month, instead of paying their taxes and insurance, they're putting that money into a different account, earning them more money and just growing their money from there. So I'm not going to get into all that. I'm not a financial advisor, CPA, or anything like that, but it really is a personal preference at the end of the day.
Yeah.
And that's really emphasized to the consumer. You can either handle it or you can set that money aside, invest it elsewhere, but make sure you pay your taxes and insurance when they come due.
Exactly. You have to be very smart and very, making sure that you're allotting and earmarking that money. But like she said, there are different programs out there, such as like high yield savings accounts. I think right now, my American Express high yield savings, it's at like 4%. So I don't have an escrow, and so I spend that $800 to $1,000 that would have gone into the escrow account, and I put that into high yield savings, so it makes me money while it's sitting there, and then I pay it in January
over time, basically.
Yeah, exactly. So it's its own escrow account. You just control it.
One thing that's not very common, but it does happen, and I just had an instance a few weeks ago where the client basically said, well, after the fact, I'm just going to cancel my homeowner's insurance so I don't have to pay it each month. If you have a mortgage, if you are financing, you have to have homeowner's insurance, and the lender will find out, and they will put what's called forced insurance on the home, and it is so expensive. I mean, it's like 5 times as much as you would normally pay. So don't do that.
Don't do that.
Don't do that. Another thing too, since we have talked a lot about escrow accounts, if you choose to change your insurance policy, you find a different premium elsewhere. Basically, you'll just get with the servicing department and everything. They'll do all the behind the scenes documentation to get that figured out for your new escrow account. And then any overage or anything like that, you'll receive a refund check back from your escrow account.
Perfect.
And that, I mean, that's really the questions that I get, in every closing disclosure is different because every transaction's different. Every lender's fees are different. I mean, so that's what's fun about this job, is it's different every single day.
It sure is. Perfect. Well, thank you so much.
That's pretty much the questions that you get. Because I know a lot of times y'all are face to face with the buyer, so they tend to feel more comfortable sometimes going to the realtor. But I'm assuming that's pretty much the gist of the questions that you get as well.
Yeah, that's the gist of the questions I get with the CD. The last thing I'd like to talk about is like the initial CD versus the final CD, because when you send out that initial CD, I feel like that's when all the questions come, right? But you still don't have everything quite finalized. Why is that?
Because there can be a million answers for that question. Sometimes, we're getting documents late and we're not uploading the file until, time's ticking and we need to get the 3-day closing disclosure out. Mm-hmm. I always emphasize to my buyers, and I pick up the phone and I call them and I let them know, hey, I'm sending you the 3-day closing disclosure. It is not final, but it still needs to be signed so we can close on time. And I just explain to them that we haven't balanced with the title company yet. It shouldn't be too far off from what you're seeing, but that's why. And I barely ever get kickback from it, but I definitely get a floor of questions right then and there. And I just have to explain, I don't mind having this discussion, but these can change. And 9 times out of 10, they trust me. They know that when I have the final, we'll go through it. I don't mind answering questions on the 3-day. And I don't want to say it's pointless too, because it still gives them a general understanding on what to expect when they do get the final. Yeah. But I tell them to put so much weight and emphasis on the 3-day closing disclosure, because 9 times out of 10, it's not accurate.
So, and this is one of the reasons I work with Stephanie, is she gets down into the details and tries to make sure that, right up until closing, we have a very smooth, easy transaction. There aren't any surprises, and not all lenders are the same. Just because you might get a eighth of a point better using one certain lender, that actually might come back and bite you in the butt in the end, just because they're not paying as much attention. There's a reason I send everyone from first-time homebuyers to my investors to Stephanie, is because she is in the details. She's making sure every box is checked and making sure that those 3-day initial CD to final CDs, there aren't changes being made. I actually had something, a very big change happen for another client that wasn't using Stephanie within the last week, which is what caused me to call her and ask all these questions. She's like, let's just jump on a call and go through it. So I just want to thank you.
Was it the mortgage insurance?
Yeah, it was the mortgage insurance. And I'm still quite confused as to why that changed so much. It was like a $75 increase. And I don't know about you, Stephanie, but like $75 on something I pay monthly, that matters, right? And what I don't want is that it was just mortgage insurance, and then there was another thing, so it was actually just over $100 increase in their monthly payment, which is just not the call I want to get from my client. Right. And then on top of that, just not something that anybody should ever have to deal with in that last couple days. So
yeah, and to touch on that real quick, it's always definitely call the lender and see what's going on. It could be because mortgage insurance is priced out based on credit and loan to value ratio. So it could be something that changed in the loan to value ratio, the loan amount, that caused it to increase as well. Or maybe if their credit dropped, there could be different reasons as to why. So always have the conversation with your lender and just say, hey, what happened here?
Well, Stephanie, thank you so much for walking through all of that for us. Any last things, comments, questions, anything like that?
No, not really. I know Holly and we plan to have a lot more videos for the future to have informative information like this, because you can Google it all day long and you're going to get a million different answers. So if you are working with a lender and you just want another set of eyes on something, I'm more than happy to take a look at it. I just want to make sure you guys understand this. It's important for you to understand, but if y'all ever have any questions, to absolutely let us know. We're local. I do loans all over Texas, but obviously Houston is bread and butter.
Awesome. Well, thank you, Stephanie, and until next time.